Hey, what's good, everyone? Welcome to Markets Unboxed with my co-host here, Ed Lashinski of Algorand Finance. How you doing, Ed?
Good. Nice to see you again, Sewell. Great to be here with you.
Definitely. Yes, nice to see you. Always a pleasure. I'm
Absolutely.
excited to get this episode on the road. So today, for the audience, we're going to be talking about crypto, the macro environment of the global economy, and how it relates to crypto. And then we'll point out a few other interesting data throughout this market. So, Ed, let's get this show started on the road. Can we start with just a general breakdown of the Federal Reserve, like a light, what its functioning is and its role and how it affects the global economy? Then we'll go into the analysis.
Sure. So we could talk for hours on that question. Broadly speaking, the Fed is an independent central bank, and they have a dual function as given to them. One is to manage stable prices. The other is to manage the employment situation. And those are the two things which normally will move in parallel with one another. So, in other words, if you have a situation where you have significant tightness in labor supply and a very strong labor market, that might lead to price imbalances and rising prices, which is what we've been dealing with the last 18 months or so. Or conversely, the opposite, where you have a lot of slack in the labor market, or you have excess of aggregate supply and a lack of price pressures in the economy, and a need to manage your monetary policy. So what the Fed does with its dual mandate is they set the short-term interest rate, and they manage the reserves in availability essentially of credit in the banking system through this process. And the primary commercial banks relate to the Fed. And the Fed essentially manages and orchestrates, by setting the short-term rate, the overall context of interest rates in the U.S. and by proxy, given the role of the U.S. dollar in global affairs and trade, it has a significant impact on the rest of the world. Not only from a capital and credit position, but equally from a lot of countries that have their currencies, for example, tied to the U.S. dollar because of its stability. The hegemonic position the dollar has in terms of global trade, where the dollar is used as a medium of exchange between countries that may have nothing otherwise to do with the U.S. It's still part of this global economic matrix, and therefore what the Fed does is of primary importance. And the dollar and the U.S. economy, being the largest economy in the world, usually sets the pace and the trend, and so there is a knock-on effect throughout essentially global asset markets and everything else. So what the Fed does is super important,
Yeah.
and it's not just the price of money, but it's also the supply of money that they also have an impact on. And both of
So when we,
these, both
when
of
we
these,
talk about the supply, it's quantitative easing and quantitative
well,
tightening.
so that is a so yes, indirectly in some ways, because the quantitative easing is the expansion of their balance sheet. And when I talk about them influencing the supply of money in the marketplace, clearly the expansion or pace of credit expansion by the commercial banking sector, the Fed there are several levers the Fed has that impact that process. As it relates to the Fed's own balance sheet, and of course, in that, again, it could be a long conversation about mechanics of monetary policy and how this impacts through reserve requirements and other types of, for example, macroprudential tools the Fed has to which impacts banks' decisions on how they manage their balance sheets and everything else. As it relates to the expansion or contraction of the Fed's balance sheet. So that is something that was done following the credit crisis, as a way to further create liquidity and easier financial conditions in the economy because interest rates were already zero. So it was a way de facto to take rates, real rates lower than zero if possible. And um, there's some hyperbole to that, but we won't get into that. But the reality is that quantitative easing effectively impacted um, the dollar rates outside of the short-term Fed funds rate in a causal way, because you have normally an upward sloping yield curve, which means short-term rates are lower, longer-term rates are higher. And that's a reflection of a few factors: inflation expectations, what's called term premium.
So right now, don't we have, I'm sure, correct me if I'm wrong, inverted yield curve
We
right
have
now.
had an inverted yield curve, and
Yeah.
in various, depends upon what part of the yield curve you look at, but yes, it's been inverted, and um, which is, by the way, typically a harbinger of recession. Some
Yep. Yep.
quarters after that happens, with an extremely high degree of historical relevance. Um, the but the yield curve, the positively sloped yield curve, is essentially is means, and this is where it affects the U.S. banking system, which is banks will lend, borrow short, lend long, basically, which means they will take deposits in, pay a smaller rate, and then they will then invest or lend, create assets on their balance sheet for a longer term, and
Mhm.
so a positively sloped yield curve directly reflects and affects the what's called net interest margin by banks.
Okay.
And this is where they've gotten into trouble this year, because in the bank will have two different areas. They'll have the held to maturity, then they'll have available for sale on their balance sheet in terms of these securities, in terms of their holdings. So the what's called held to maturity, which are long-term holdings, which typically will buy something and again, as it says, hold that to maturity, so they don't have to take the mark-to-market losses per se. Um, and what's happened is that part of the book has become very, there are a lot of embedded losses, and even though we've had a massive rally in the bond market the last month, which has certainly helped in a pretty significant way, there's still a lot of pain there. And what's happened is a lot of U.S. commercial banks had assumed wrongly, and with some degree of guidance from the Fed prior to their shift to significantly and rapidly tighter monetary policy, that rates would be lower for longer, and that their funding costs would be essentially zero or close to zero, 40, 50 basis points or so. And instead, what happened is everything went the wrong way. So long-term rates went straight up, short-term rates went up even more, yield curve got inverted, and then banks had a bunch of embedded losses, and we had the problems we had in March of this year. Um, and we had that right. I mean, I mean, yeah. I mean, it's the large, like J.P. Morgan, Bank of America. I mean, they have these are big, sophisticated banks, and they know how to manage the vagaries of interest rate cycles, monetary policy, and the economy. They have not been caught out. I mean, Bank of America had several hundred billion of embedded losses, but these guys were big enough and smart enough to manage this well. Silvergate and a couple of the others were essentially caught with their pants down, and um,
Definitely.
they did not. They made some really bad decisions,
So Ed,
yeah.
can we dive into some of the slides that you have here and
Sure.
discuss them?
So let's do that, and I'll just
Yeah.
mention these slides so we talk about what's going on. So
Okay.
in other words, back to your question. So what the Fed does, the Fed seeks to support healthy functioning of the U.S. economy, and because the U.S. economy is a leader of the global economy, it affects the rest of the world as well in a number of different
Yeah.
ways through a number of different channels. And because the economy is a credit led economy. In other words, we have a fractional banking system where money is being constantly created. The
Mhm.
Fed's impact on that is primal and causal toward its how the economy functions. And through the primary channel of the market's expectations of what the Fed's going to do, because often the markets will, as we're seeing now, and as we always see to some degree, um, the markets will anticipate, because everybody's always forward looking, right? And
Yes.
this again is the yield curve. So when you talk about the Fed quantitative easing and tightening, so the quantitative easing, which followed the GFC, was a way for the Fed to impact the term structure of rates, which means that as you go from overnight rates to 2-year to 5-year, 10-year, 30-year bonds,
Yep.
the Fed's purchases of these, as well as mortgage-backed securities, sought to lower those by buying these. And that therefore is a way for further easing in the economy when you can't take the short-term rate below zero. And
Okay, let
so,
me pull this up.
mhm.
Yeah, here's the first one. Okay.
So this is courtesy of our good friends at BMO, who are outstanding fixed
Excellent.
income analysts. And this is just simply showing right now that this is the effectively the where real rates are relative to unemployment and everything else. And so we can move on to the next one as well, and I'll get into more of these. But the point with these is that in this particular case that we had, for example, Q3 GDP over 5%. The current, as of yesterday, the current Atlanta Fed now GDP estimates 1.2%. The market now is reflecting. This is one thing. So it's showing the effectively the market pricing interest rate cuts into late quarter, early Q2 next year.
Mm-hmm.
And
Wait. So you said interest rate cuts. Right now, just to put a little context, we're about 5.5%, and we're
roughly,
seeing interest
yeah. I mean,
going down.
yeah. So right now the Fed has. So right now the markets have priced 5 quarter-point cuts in 2024.
5. Okay.
5, which when before we were about 2. So we've priced between 50 and 75 basis points of additional cuts in the last little while. And just to finish off this balance sheet discussion by the Fed, because it impacts
Yep.
all of this, which is that so the Fed basically sought to bring longer term rates lower as well as a way to continue easing financial conditions when you had deflationary concerns. And while we don't necessarily need to get into a long discussion of deflation and inflation and the perils of deflation and the concerns around that, but the point is that through the suppression or through the buying, it's had a couple of very important features. One is that it's designed through what's called the portfolio balance effect to essentially affect credit markets in a positive way, where if the Fed comes in and buys bonds, if you're a bond fund manager, you will have your holdings displaced. And the idea is that you have what's called a kind of a risk pyramid, where U.S.
Mm-hmm.
federal debt sits at the top of that as a risk-free asset, and then below that you have highly rated investment grade corporate bonds, and you have less investment grade, then you have junk bonds, then you have so on and so forth. You get down to equities, and you get and so as you take more risk and that type of thing, right? So
Yep.
by virtue of the Fed buying bonds and expanding their balance sheet, that has had a direct and material effect on the stock market and on the rally and the price of financial assets. Okay, so.
Yep.
And through that, then is viewed this lever that with that happening, that would trickle down into the real economy. It would spur additional consumer spending, animal spirits, easier credit availability, all of these things. And that's been one aspect of this quantitative easing story. And what it's done is it's effectively, one of the arguments, of course, at the outset was this was inflationary. And now since the plague hit us in 2020, there are a number of factors that caused this to kick in, and I think economists will continue to be discussing this for many years to come in terms of what the actual impacts are, how the supply chain disruptions affected that. So in other words, this balance or imbalance between supply and demand led factors in the economy and inflation, and how monetary policy contributes to that. But make a long story short, we have had a situation where, by virtue of the Fed buying somewhere north, I think it was almost 10 trillion in terms of their balance sheet at one point. This is a massive percentage of GDP, and what this has done effectively is allowed the U.S. government to borrow a lot more at lower rates. And now what we're seeing, and so again, there are multiple sides to the story, and we could discuss this for several hours. But in essence, this part of the story is very important because it's created, and of course, as the Fed runs down their balance sheet, now the opposite will occur, where the government will have to, this kind of there's a crowding out effect that now is happening on the supply side, where the government's debt burden has increased a lot. The Fed allowed the government to spend more money and effectively, you'd say, monetize the debt. But of course, when the Fed runs down their balance sheet, that's not actually the case. But there are elements where that can be prolonged significantly for quite some time. And so,
So when you
um,
said unloading debt, so who's picking up the debt that the government's offloading?
so we're dealing with a situation right now where I think the statistic is one half of the federal government debt right now will mature in the next 36 months. And
Okay.
from short-term rates rising as they have from essentially 0 to 5.5%, the and the government has not extended the term maturity of their debt significantly, but um, what you will see are dramatically higher borrowing costs the government has to pay, and so you've had the debt burden rise significantly in the last year or 2 years. So there will be this crowding out effect basically means that the higher proportion of the federal government budget will be geared toward allocating interest expense.
Mm.
And that will cause pressure on their ability to fund other important necessary programs. Um,
So
and
like these programs in terms of just like government spending for,
yeah, the
the
government balance.
country.
So
Yeah.
yeah,
Okay.
exactly. So you talk
Yeah.
about
Okay.
defense spending, you talk about
So the interest is, from my understanding, the payment is going to be higher than
there,
the government
some
military
estimates have
spending.
this upwards of 10%, 11% of the budget,
Wow,
and it's huge. And
that
so
is
again,
huge.
so this represents a drag on the government's ability. And of course, they've spent a lot of money, and this money they have spent. So you've had post uh, post the virus outbreak in 2020 and all of the massive disruptions which followed, of course, the government, and so both fiscal and monetary policy were eased massively and substantially.
Yeah.
And so while the Fed has now taken rates off of zero and hiked them at the quickest pace in decades, the government also flooded the economy with money, and now a lot of that in the last 12 months or so is being drawn down and spent down. And so that is where we're seeing kind of the maturation of that process as well. So again, now we're in a situation where if the economy slows precipitously, as it is doing right now, the functional response by the U.S. government to do more at this point is probably pretty constrained, and
Hmm.
so the it will fall upon the Fed to make that adjustment, and the Fed having egg on their face from now almost 2 years ago with regard to this inflation expectation that was viewed to be transitory,
Transitory.
not to be transitory.
Yep.
They have a credibility. They've largely restored the credibility because everything has come back down. I think one of the charts I gave you was, I don't know if I gave you one of those about CPI and inflation numbers, but basically we've seen a pretty sharp turnaround in inflation in all levels. Come back down. So the core PCE, which is what the Fed follows, is now running at a sub. Last print was sub 3%,
Hmm.
and we are likely, if this continues, to be back well within under 3%. As things go forward, you look at CPI, you look at, and actually the coming week, we're going to have key inflation and retail sales statistics. So CPI, PPI coming out this next week,
Yep.
just before the Fed meeting. We also have retail sales. So those that will be very important. We have recently seen today, yesterday for me in Asia right now,
Yep.
But we had the University of Michigan 1 and 5 and 10-year inflation expectations that came out, and those dropped precipitously, very sharply, even though current conditions and expectations actually improved. But relatively speaking to this inflation narrative, there's a growing confidence in inflation. The inflation threat has been assuaged, and that Fed policy has worked. And so concerns around the Fed credibility and maintenance to continue that have been supported by the recent macroeconomic developments, which is helpful because right now the big debate is, when do they cut? First, are interest rate hikes over? And second, when do they cut? And the big transition in the last month has been from the Fed may hike again to the Fed's not going to hike again, to the Fed now is going to look at potentially cutting earlier than expected. And this is a consequence now of, when you look at how the markets work. So you had I think 5.1 or 5.2% GDP for Q3. I don't remember exactly which one it was. And now it's the latest Atlanta Fed now GDP, like I said, is 1.2 and probably heading south. So when you look at Fed funds, call it 5.5 and a 1.2% rate, then you've got a GDP rate. Obviously, deflator is what matters here, but just as a 30,000 foot back of the envelope analysis, you have basically a 4% just over a 4% real rate, kind of. So it shows you, and again, this is not the correct way to basically you have inflation, you have nominal GDP, and then you've got real GDP. Real GDP is what that number was, 5.2, by the way. But the point is that as it relates, so this is a specious comparison I'm making right now. But the point is that with real GDP now estimated at 1.2% from over 5, I think if it was 5.1, this huge drop, and this is not unexpected either, relative to what's been going on, but this huge drop means that, ceteris paribus, that with short-term rates at 5.5%, you have this massive gap now in terms of the tightening of financial conditions around the real rate now, basically, right? Because if the economy, if growth drops that much and the rate stays up here, you have a effectively much tighter monetary policy now than you had before. And this is why the markets are responding the way the markets are responding. In other words, long-term rates have dropped a lot, short-term rates have also dropped a lot. And this is why there is some teeth and some substance to this interest rate cut expectation. And most importantly, I mean, all markets always usually can only look at what's in front of their nose, first of all. And secondly, they can, when it comes to monetary policy and pricing of that in the interest rate markets, they go through it. It's one step at a time. So the first step is ensuring the Fed's actually done tightening, that outlier chance is largely ameliorated. And then second, and that was part of the process and the pricing that we've seen. And the second part then was the actual pricing of further cuts. And now that's what's also happened. And this has been supported by the data. It's been supported by all of these things. And the Fed, in fact, last week ago, Powell's speech that he made was much less hawkish than it could have been. And in fact, discussed more the potential loosening of the labor market and less the concerns about further inflationary threats. And so where all this is going is that because inflation has come down, because growth has come down, and because the Fed's tightened so much, concerns about the Fed needing to essentially over-tighten or maintain a higher rate for longer than would normally be justified in the milieu of monetary policy for the last 30 or 40 years.
Excuse me. Can we now relate this to crypto a little bit? So we know, for those at about the time of this video, Bitcoin is at 44,000. It has touched 45K.
So
can we relate that?
Sure. So just to finish that, though, the idea of the Fed needing to maintain rates higher than would normally be the case
Mhm.
because of a credibility issue, is also moving in the right direction, which means that while the markets are certainly maybe and probably will be walked back by the Fed this coming week as being a little
Mhm.
too aggressive,
Yep.
the correction, if it occurs, and this is also, it impacts macro global markets, is likely to not be overly fierce because the Fed knows that every time you get an unemployment rate increase of 50 of 0.5% over a 6-month period, um, with only one exception, which was 1951, do you have a recession which follows? And so this immaculate soft landing everyone's expecting is highly unlikely to be the case. And the Fed, while everybody has believed this, it's the Fed, I think, is coming to grips with a sharply decelerating consumer and economy right now, and they will be noting that. And in no time historically since World War II have we had a 9-month period where the unemployment rate increased by 50 basis points or more, and a recession has not followed. And so right now the markets are looking ahead to all this. But the point is the sharp increase in the unemployment rate, with only one exception, has always been followed by a recession. Okay,
Mm.
so the point is that there are that these recession concerns. Then you talk about the negative yield curve, which you mentioned is also being a harbinger. And there are a bunch of reasons why that is the case. And again, we won't go into that here today. But the point is that these are all leading up to, in the recent data, very sharp slowing. All of this supports the huge market adjustment that we've had. And the
Yeah.
Fed, and actually puts some pressure on the Fed to cut rates sooner than they want to cut rates, right?
Mhm.
And so this is where this meeting coming up this week will be super important for crypto, for global macro markets as well. And crypto has significantly benefited from this paradigm shift with regard to U.S. monetary policy toward easier or lower rates, being able
Mhm.
to price now. Because the markets tried this earlier this year and they were brought back, right? They tried to price interest rate cuts and the Fed turned around and the data then didn't fully support that, and it was too soon. And now the markets have turned around, and now there will be some substance for their ability to maintain or sustain this type of pricing, even though short-term conditions in across all these markets that have repriced so aggressively are probably overbought at this point. And that also may include crypto.
Yeah.
Um, and in also one other point on the unemployment. So not only did we have these University of Inflation numbers that came out as far as inflation expectations, the key monthly U.S. labor market report that came out showed actually the unemployment rate dropping by 0.2 from 3.9 back to 3.7. It showed a higher than expected number of job gains. And it showed importantly, the labor force participation rate also edging up. So, and wages increasing to 0.4 on a month over month rate as opposed to 0.2 expected. So higher wages, better employment, and this will also give the Fed. Well, the Fed should also like this.
Mhm.
It, however, though. Um, uh, Takes away from the sharply easier monetary policy pricing, though.
Mhm.
And the year over year pace is not going to significantly change in terms of wages. But the fact that you had an expansion of the labor force and a drop in unemployment is actually very positive. So, it again, this idea of this immaculate conception and the sharp recession fears may be allayed to some extent by this report, or at least cause some pause. And that
Mhm.
pause, given the current state of the markets, may result in a bit of a retracement, given everything is at more or less extremes at the moment relative to the cycle.
Yeah.
Crypto is, and now with Bitcoin at 44,000, Ethereum at 2,350, and even Algorand, for example, is
Yep.
massively rallied. Altcoins in general have significantly outperformed Bitcoin now. This huge shift And obviously buoyed by a lot of growing positive sentiment in this space. I mean, for example, we look at like the movement of Algorand the last week.
Hmm.
This is a less than 1% historical incidence rate, which means it's into almost 3 standard deviations in the last 7-day movement. And now in the last 12 hours, we've seen another increase in price of essentially $2. Which is now it's another 10+% move in 10 hours. So volatility is rising. The markets are euphoric right now. And that again is very hard to say, okay, because you can look at traditional markets and you can say, well, traditional markets are, with some degree, you can talk about where they may be overstretched, or you may see natural areas. For example, you look at the bond market, and you look at the yield curve against present monetary policy expectations, where you think things are, where they can go, and what's priced, what's not priced, and all of that. And you look at the stock market, and you can look at what how the forward earnings are reflected, and everything else. But crypto, it's very hard to say, okay, with markets rallied a lot, it's overbought, sentiment's very positive. By all leading traditional finance measures, you would want to be probably taking profits here. Um, but it's very hard to gauge because, again, things can go a lot further than anybody thinks. And what I've been looking at, and maybe you have an idea about this, is that when you look at the amount of actual capital coming into crypto, of course, the overall, when you look at the overall market and the overall market size, for example, of crypto right now, as we speak, it's about, I think, 1.7 trillion. So it's come up roughly 500 billion or so, maybe even a bit more than that. But where have we seen the actual capital coming in, right? Have we seen a massive increase in Tether or Circle, for example? Have we seen, how is this price rise being propelled? Is it by outside capital coming in? Are we seeing, I haven't seen that, and I might be missing it. And
Yeah.
I'm sure there are guys that are more on the ball with this than I am, who can, you
Yeah.
know.
From my understanding, yeah, a lot of stable coins are rebuying as well. Like you
Mhm.
mentioned, Tether. But yeah, I'll have to dive in more. But that was the last data I seen from people I'm watching that track those type of
Mhm.
correlations. But speaking of crypto, let's slowly start to close out, and I would
Sure,
like to focus on Algorand and
sure,
then talk about exactly kind of what y'all doing and speak on some of the insights that you got this week as we close out.
sure. Thanks for that. So what we do right now, we have a core set, core value proposition, which is,
Mhm.
we create these structured products, these yield strategies around people that hold crypto, whether it's native or stablecoin.
Mhm.
And typically, the way these things work, and we're seeing this now with this huge volatility in the markets. Um, and if you're holding the asset, you can achieve an additional return without taking counterparty risk by coming to our platform and selling effectively covered calls, which give you, you're in exchange for income today, you're giving away potential upside over a span of time.
Mhm.
And statistically, this works over the long term. There are always incidences where it may not work. This last week was the first instance, in fact, I think since January, where I said
Mhm.
we had this almost 3 standard deviation move in Algorand. So our calls that we've been selling every week and making money and adding to the holders' assets gave back a little bit today.
Mhm.
Now they gave back in the sense of our strategies, but that's also because the market was up 25%. And
Yeah.
so that means that instead of making 25%, they only made about 21% or so. Okay. So it's not like they lost money, but the point is that there's always a trade off inherent in all of these markets. And our job is to create the best risk adjusted return that we can, for the investors and for the clients and the users that come into our platform. where we're looking at how do we find and manage opportunities on a sustainable basis. And so effectively what this means is that unless you have these types of things, I mean, you're not going to get 25% rally every week, right? So
No.
if we in the recent returns, the APR, like for example, the auction we just had on Algo, was over 30% on an APY basis. So market makers are paying up for calls now and paying up for puts as well. They're paying up for options, and because of this high volatility inherent in crypto, we basically can extract that and pass that on to the users, the holders of the crypto. And that's what we do as a core value proposition. We also will have vaults now that are starting where if you want to hedge your risk, your price exposure, let's say you're holding Bitcoin and you want to buy some puts or downside, we can do that. And the other thing we can also do, which has been quite a nice strategy in recent months, particularly in this nascent bull market, is that we have deliverable downside strategies or downside puts, which means if you're holding stablecoin, you come into our platform and we can sell puts on Bitcoin, Ethereum, or Algorand, and those can be deliverable. And so you're selling something, and so effectively you're picking up premium over a weekly basis, on an ongoing weekly basis. And if the market drops by say 10 or 15%, you'll convert that stablecoin into crypto. So you're basically buying at a nice discount. And this is what we had some people that came in that were able to do this at 1700, 1800 in terms of Ethereum, where the market dipped down, the puts went in the money, they were able that USDC got exchanged for Ethereum, and now they had a core Ethereum position. So some of these strategies are very nice to manage that. What we're now doing going forward is that we're going to be creating a new, we're going to be expanding this, and we're going to be incorporating real world assets yields in DeFi. And so we're going to be talking about gold. Yes. So gold is I think the next time we talk, we can dig into this a lot more, because gold is a fascinating market, and it's one that I've spent much of my professional career in analysis and trading of. And it sits in the crossroads of all global markets. And so understanding gold and what motivates and moves gold is very important to understanding the stock market, the bond market, expansion and contraction of credit, foreign exchange markets. Now, we didn't have time to touch on Bank of Japan, the pivot that's going on right now. Nor did we talk about the fact that you had a $100 round trip in the price of gold on Monday and Tuesday, early this week, which is the largest move I've seen in a long time. And we don't know necessarily what's behind it, but all of the core asset markets have been reasonably highly correlated, and so gold will typically move with interest rates or the bond market mostly. And it's also tied to the U.S. dollar, and is the longer discussion we don't have time for today. But the point is that gold peaked out, exploded, and then reverted back down again. And now I think gold's part of this cycle, which outperformed the bond market on the way down when yields went above 5% for 10 years, and everyone got scared about the Fed, the federal government, the supply situation, all of these things that are going on. Not without some merit, by the way, but the market was absolutely over the skis the wrong way when it came to long-term rates. But gold outperformed. Then it had a setback, and then it blew up. And now that it's blown up, it's basically priced the best it can for the moment. And now the internal market dynamics are also something never to be ignored, right? So we've now seen a situation where
I know.
It's probably done until we see an actual green light by the Fed or an actual significant shift that happens that will allow gold to rise back and challenge those highs put in this week. So in other words, the bull move in gold, I think, is over for now.
Already happened.
But it doesn't mean that we're starting the bear market there either, because I don't believe yet that we're in a situation where I've been very bullish long-term bond yields now for several months. I was about a month ahead of schedule, which is usually the case, which is its own danger. So I'm not bearish gold, but I think for the moment it's put a short-term top in. And
Makes
other
sense.
markets, and this price action and price behavior may also relate to crypto. For example, you might see Bitcoin rise to $1,000 and then drop 3 or 4,000, right?
Yep.
This is the type of
What
price.
about tech? What
Yeah,
about tech? Tech sector.
I mean the tech sector is tied to crypto, right? And
Mhm.
so the relative situation of a compression of interest rates, particularly longer term rates, um, improves the NPV of tech assets because the cash flows of these assets, which are far out into the future, are strongly impacted by long-term rates. In other words, higher long-term rates represent either opportunity costs or higher capital costs, and so lower long-term rates therefore improve the multiple for techs, the tech sector, and this is no doubt contributed in general to the rally. Tech has massively outperformed everything else. I think Nasdaq's
Yeah.
34%, something like this year to date.
Yeah.
And it's again, we're still in a bubble. We're still in a liquidity bubble around the world, despite the fact the Fed's raised rates to 5.5%, despite all these things that have gone on. And in some sense, because when you look at from a value perspective, it's very hard. The market's priced for perfection in some ways. Certain markets
Hmm.
are, and again, this is what markets do, right? But it's notable, right? And it is something where clearly there is still liquidity around, enough liquidity to perpetuate. And this comes back into crypto, where we still have this ongoing evolving value proposition, where from regulatory perspective, this is still in need of a framework which makes sense, and it will happen, and the value proposition on crypto is real and it's massive, but we're still in the very early stages of this process because um, the key value proposition as it relates to global capital and credit markets is the ability to tokenize and to create an efficient vehicle for lending and borrowing in crypto, right? And so you have this issue of a lack of regulation, which is keeping out fiduciary capital right now, because they can't invest or they can't participate in things where there is no regulatory framework. And a fiduciary, by definition, means you can sue someone in a court of law, right? So that's first. And secondly, the actual valuation, which is what we've been talking about crypto. When you look at a stock or you look at a bond or another asset, there are ways in which you can value that asset. And it's usually based upon cash flows, and certainly you can do this in some sense for Ethereum and for, you can look at fees, you can look at some of the network effects and things like that. But the reality is, there's no actual substantive way to look at Bitcoin or to look at Ethereum or look at Algorand and say this is what the value should be based upon. You can base it upon certain metrics, but the point is that because you don't have a defined rigorous valuation model or methodology present, it means as a professional investment manager with fiduciary responsibilities, it becomes a more speculative process than an investment process. That too is keeping a lot of money out of crypto. So again, this is a value proposition I'm 100% sure will be solved in coming years. Um, but it's also part of the current challenge. And that means then how are we making this process an economical one? And what are we doing about it? And so from our little point, our corner with Algorand, we're going to start also a very selective strategic capital raise on this new gold and real world asset tokenization process that we're going to be doing. But basically, what we're doing is we're going to be facilitating through a combination of traditional markets and crypto a real yield in DeFi. That comes in, um, and the point though is with all of this is we're using and looking at a market-based focus and solution because this is who we are and how we're set up. But the point
Mhm.
is with all of this is that there needs to be real economics behind what's happening and what we're doing, and that's our striving and sole focus is to create real value for market participants and an economic reason for developing this type of business and in creating and in increasing the liquidity space that we sit in because that's really key. And the more that grows, the more confidence, the more people see that use case, the more that there is real efficacy, and it's not just buying something because you think it's going to go to 100,000 or whatever it may be, right?
Yeah. Yep.
And that's kind of the whole premise behind what we're trying to build is something real and something that will be substantive in terms of its value proposition from an economic perspective.
Excellent. Great breakdown, Ed. It has been a pleasure talking about
Likewise.
the market with you. For sure, on the next episode, make sure we dive in deeper. I would definitely love to learn even more about what Algorand is doing with the gold, because that is something that is very important, as you said, for the global markets. Great breakdown. Any closing words you want to say bye to the folks?
No, just thanks a lot for having me. It's great to have this discussion. It's always nice to, again, part of the process is again, it's the narrative that we're telling, right?
Yes.
And trying to help inform as much as we can, and if not inform, provide some basis for discussion, whether you agree or you disagree about this issue, because a significant I think there's a lot of ignorance in the marketplace in general, not among obviously our participants or our viewers, our audience, of course, but in general, there is an ignorance may be also seen as reluctance, or could be seen as a barrier to entry for a lot of people because they don't understand what it is we're dealing with. And I think that in general, the marketplace, and we're still, and this whole thing is still evolving, right? And this is why regulators are also having a problem because this is a new technology, it's a new way of doing things. And so you do have, you have parallel channels of development right now. You have native crypto developing in terms of prices, in terms of what's happening there, in terms of development. On the tech side, you have tokenization, which is part of that, but it's a separate stream of tokenizing real world assets and tokenizing that process. What we're going to be doing is essentially tokenizing in extracting the yield that comes from that process through our through Algorand. And the third is CBDCs, right? Each of these are uniquely different and or have their own particular unique features, but it all represents this growing kind of use case of this of blockchain and then cryptocurrency. And so, but there's a lot of, and I can speak for myself as well, that there are a lot of people that are not well informed about this at all. And I just hope that through our occasional discourse like we have, that hopefully maybe in some ways we can all kind of learn as we go along and dive a little deeper into some of these issues where there is uncertainty, there is a lack of information or clarity on some of these things. So anyways, it's great to be a part of this, and hopefully we can continue to create and grow as we go forward, and incrementally in an organic kind of way, right?
Most definitely. All right, y'all heard it here. Thank you for tapping in and watching Markets Unboxed with Ed Lashinski as our special co-host. This is episode 3, and we'll see you in about 2 weeks for episode 4. Y'all have a great one. Peace.